If you would like to know more about how we account for equity in companies, this video will help you understand some of the key concepts so that you can use this foundation in later units in your degree. How we account for assets, liabilities, revenue and expenses is generally the same regardless of which form of business organisation our firm uses, whether it is a sole trader, partnership, company or trust. However, the way we treat equity is very different depending on our form of business organisation. In this video, we will focus on how we account for equity in companies. The amounts of each type of equity are included in a firm's balance sheet each year. And various information is also included as footnotes in the financial statements. In addition, equity is a bit special as it has its own financial statement, the Statement of Changes in Equity. For a company, there are two main components of equity in the balance sheet: issued capital and reserves. And a particularly important type of reserve, which is not even called a reserve, is retained earnings. Issued capital is required to be shown separately for companies. It shows the amount of assets invested in a company by its shareholders. But this is not all there is to equity. Reserves are also required to be shown separately. Although reserves are required to be disclosed, nowhere in the Accounting Standards, Conceptual Framework or Corporations Act are reserves actually defined. So we will use this definition of reserves. Reserves are those parts of equity not represented by issued capital. Reserves represent increases in the value of the net assets of a business over time that have not been distributed to equity investors, but retained in a business to support its growth. Reserves can be set up based on transfers directly to equity from other comprehensive income, or from transfers from retained earnings. In another video, we will look at the rather special type of reserves, retained earnings, into which all the net profits of a firm are transferred at the end of the year. One thing to be clear about is that reserves do not mean the company has cash in its bank account backing these reserves. An asset revaluation reserve is a reserve many firms can have. It represents the increases to fair value of property, plant and equipment or of intangible assets when we revalue them to fair value. For further information on two parts of equity, go back to Chapter 8, Section 8.1 in the study guide, and also review the Equity Weekly questions. Also answer, write and rate questions on equity in Peerwise.